Welcome to the Collecting Keys Real Estate Investing Podcast with your host, Mike DeHaan and Dan Austin. From wins, losses, horror stories, and tactics for optimizing your business, Mike and Dan take a real, uncensored deep dive into the ins and outs of running a full-time real estate investment and wholesaling business.
What's going on, everybody? Welcome to episode 41 of the Collecting Keys Real Estate Investing Podcast. And Dan, it is finally happening. Something that I have been predicting for the bulk of the last year and a half, I would say. The Airbnb market is bursting.
Oh, man.
Everyone that I talk to that has Airbnbs, of any real capacity, they're just like, oh yeah, stuff is down so much right now. Their bookings are significantly lower than last year. They're having to drop their prices. Their future bookings are dropping very significantly. I think the only people I've talked to, mostly in GoBundance, different people that have portfolios kind of all over the United States. I think the only people I've talked to that said they haven't had that are people that have stuff in like the Florida, beach sort of areas, which since it's,
Right.
prime beach time down there makes
Of
sense.
course.
But people that have things like in the Smoky Mountains, people that have things in like Colorado, people that have things all throughout Southern California, a lot of them are like their Airbnbs are just a freaking disaster right now.
Yeah.
So
I mean, I'm not glad to hear that, but I'm also kind of like, I agree with you. I've had we're not experts at Airbnb, but we've done our Airbnb stuff and, that it's just okay. It's not for me,
yeah,
it's not worth the effort. And then when you're underwriting based on STR, like data that you're using from an epic time in STR history, which was 2021, 2020, and 2021, you're going to probably be missing the target on what your actual cash flow is going to be.
correct. Yeah. And see, I think that's the thing is, we're not experts at Airbnb. We are experts at analyzing real estate and buying
Yep.
real estate investments at this point, which is kind of I don't know, maybe ego thing to say, but I mean, we've done like 100 something transactions the last couple of years. I think we can officially say we're experts at this point.
Yeah. We know how to underwrite
And
deals,
yeah,
and the other thing that you don't know getting into is there's actually a lot of additional costs to running an Airbnb, like local, like business operation tax being one of them, which you
mhm.
don't have with your long-term rentals. At least we don't in our markets. Long-term rentals don't get taxed that way. There's just a bunch of other little costs. You think about the cost of maintenance and, furnishing and all that sort of stuff, but there are additional costs on top of that you're kind of like, well, once you learn it, you're like, it's less appealing.
Yeah.
And I would argue that I would still love to own an Airbnb on the beach in San Diego or Florida because humans love water. Humans love good weather. They're always going to
Mhm.
go to those, even though those places do see kind of a depression in prices if the market's low, because less people are traveling to destinations like that.
Yeah, well, and I think there's kind of different ways you can, you have to view them as well. So, like a lot of the people that I've talked to, which has been probably about a dozen over the last week or so, that have been expressing this situation. The ones who are like, yeah, but like my family and I use that Airbnb, so I'm not really that worried about it. Like they go there for vacations. That's
Right.
fine. That makes sense.
Second
And
home.
honestly, that's kind of what the system was built for. Like the
Mhm.
system wasn't built for people to have these big empires that they're all running remotely and doing all this
Well,
this
let's
whole
let's
sort
step
of
back
thing. I
to
mean,
the system is what it is it's a typical, it's actually ingenious. Any of these things like Uber, Turo, Airbnb, it's using excess capacity in the system. So if you have a primary
yeah.
residence and it happens to be somewhere where people might go, or even where we're at, like I have a whole basement set up at my house where I wouldn't even know you lived here because
Mhm.
it's just separate from the home. And I could rent that out and make a few $100 extra a month or $1,000 extra a month. Like that's excess capacity, right? And then when all of a
Yeah.
sudden you're buying homes, like, and people start staying there, over and over again, now you're all of a sudden you're making $150,000 a month in gross revenue from all of your Airbnbs. That's a business. That's different. Might as well buy a hotel at that point, right? Because that's what you're running. You're running a
Correct.
hospitality business. The one gripe I've always had with Airbnbs, and why I typically choose not to stay in Airbnbs. One reason is I don't usually travel with a group of young adults who are all willing to stay in the same home. I usually travel with my wife and kids, but the reason why I have such a gripe is it's like, man, that is super expensive to have the convenience of like my own kitchen. That's
So
about it.
expensive, and it didn't used to be that way. Like
Right.
when, we first started using Airbnbs, we I guess we've used them a lot less recently just because they've been so expensive, but it used to be like the cheap alternative. I mean,
Mhm.
like you said, it's for excess capacity. Airbnb literally stands for air bed and breakfast. Like you're supposed to stay on an air bed at someone's house and then they give you breakfast afterwards, for staying there, right? Like that was, if you listen to, there's an
Sounds like a one
interview with
night
the
stand.
founder of Airbnb. Kind of, yeah. I mean, so if you listen to, there's an interview with the founder of Airbnb on Tim Ferriss that's probably 4 years old now. He talks about the premise of that. And like literally the whole premise is that, you're a guest in these people's house. Like there's supposed to be super basic hospitality.
Mhm.
And it was supposed to be like a cheap alternative. And when they launched it, it was mostly around, I think it was South by Southwest was the first event that they launched it for. And then it was
Mhm.
meant to be around like events, right? And then it
Right.
became a way that people travel and they can stay place all over the world, which is fine. But where it gets super dicey is when you have these people, especially over the last year, there's been so many gurus on Instagram that are like, here's how you can quit your job like this year by buying Airbnbs. And they're like, all you have to do is, you use these tools to analyze Airbnb cash flow potential. And then it doesn't matter what you pay for the property because it's going to cash flow. So we see this a lot in North Idaho. You have people that came out
Mhm.
and they were buying properties for like 10 to 20% over retail value because it made sense as an Airbnb off of last year's cash flow numbers.
Yep.
But all of a sudden, those numbers dip 40% because no one's staying at your crappy property that you didn't put nice furniture in. You didn't actually make worth the price you're hoping to charge. You're in big trouble because you now have a asset that you overpaid for significantly and is going to cost you money to liquidate, right? Like there's a
Mhm.
transactional cost to real estate. So all of a sudden, you're going to be eating it super hard.
Correct. Yep.
And you're seeing that everywhere. And something else that's happening right now as well, coming out of COVID, stuff starting to open up again. Hotels are wanting to start make money. They're getting like more
Mm.
competitive with their prices,
Sure.
whereas Airbnb is full of a bunch of people who are getting greedy, right? Because
Mhm.
they're trying to charge way too much money for those assets they overpaid for. So, like
Yep.
my wife and I, when we were traveling, in Spain a couple weeks ago, we stayed in a 5-star hotel in Barcelona. It was like $120 a night, a five
Yeah.
star Marriott hotel.
They
Like
make
like
your bed
3
for
years
you
ago, it
every
would have
night.
been $500 a night, right? It would have been so much
Yeah.
different, but now it's a cheaper alternative than
Yep.
Airbnb, and I don't have to do anything. It's clean. I don't have to worry about people putting cameras in the toilet to watch me poop or whatever, like, maybe, but, like, like,
Oh
serious
god.
stuff that you have to think
You're
about with
right. You're right. Yeah,
Airbnb
you're
now.
absolutely right. Yeah, there it's and maybe it's just capitalism at its finest where people took what I perceived Airbnb as a place to have more of a community where you're traveling, like a traveling community where you're staying with a person and you're meeting somebody new. If you stay at
Mhm.
a hotel, you don't tend to do that. You go to your room. It's just that there's no community there, and it's a cheaper way to travel, right? So you could pay somebody $40 instead of a big hotel corporation $200. It's changed, right? Capitalism took
Mhm.
over. People saw opportunity, and now the hotel people, who I strongly believe have a lot more political sway and a lot more capital to withstand market shifts or to withstand price shifts than the little Airbnb person who stretched to buy this third home
Mhm.
in Florida for an Airbnb business, and they quit their job because they're making so much money.
Yeah, exactly right. And yeah, it'll be interesting. So I mean, from a investor perspective, if you're a opportunity seeking investor, like you should be, if you want to take this game seriously, you do things
Mhm.
like we do, and like we teach our students in the instant investor program to do, where you market for your properties and you try to find these discounted properties to be buying well. If you can think of a way to start targeting people that have bought rental properties like short term rentals in the last year, I guarantee you there's going to be some good opportunities that come up,
Right. Yeah.
especially in markets that had major growth. I was actually thinking about this morning. I wonder if there's a way we can pull a list of people that have properties listed on Airbnb in North Idaho that have bought them in like the last 18 months. Because North Idaho is bubbly, right? And like I know
Yeah.
there's going to be some people up there that are going to start hurting here pretty soon.
Yeah.
And and especially if they were overpaying for stuff, they probably have decent money and are going to value the convenience and have a little bit of fear. So if you can go, I mean, they'll
Yep.
probably take a haircut if you can get them out of a
Yeah.
situation they've got themselves into.
Oh yeah, I think there'll be a lot of opportunity coming up where people bought things in a frothy environment. And I think
Hmm.
that's where you and I are. Well, let me step back. I would say too, there I've talked to quite a few people over the last couple of years that's all they do is Airbnbs. Right. Let's like, I
Hmm.
guess, stay on this topic. Like that's what they're like, I run an STR business. I'm like, that's cool. They've got 10 or 12 of these properties. They're making really good money and they run it as a business. It's not like a long-term rental. It's a business. But like, that's like they're the one trick pony. There's a handful of other people that I know who recently in the last 3 to 4 years stepped into apartment syndication. That's all they do. They syndicate, they get other people's
Hmm.
money. They call brokers in cheaper markets than where those people live. Right. So they get a bunch of people's money from, California, New York, other, wealthy states. And then they go and call, a broker in, say, I don't know, Ohio or somewhere there and say, hey, do you got any deals? And they make a relationship and they're like, yeah, I got a deal for you. It looks like a deal, but it's really probably not that great of a deal. It's just that it's super
Hmm.
cheap compared to where you can buy things in your market. And so that's what they do. They
Hmm.
syndicate. They're not necessarily property managers. They're not necessarily property investors. They're syndicators. And so they're this kind of one trick pony, where I don't think when you have market shifts like this, those people can sustain it, right? If all of all of a sudden all your Airbnbs shut down or reduced by 40%, you're in trouble. If you can no longer syndicate right now because interest rates have gone up and so many deals have been blown apart, right? And
Hmm.
their investors are kind of getting scared, like, well, let me just hold on 6 months. Well, can you sustain 6 months without an acquisition fee, or 6 months without adding some cash flow to your portfolio? Maybe not. Um, and
Yeah.
so as you pivot and adapt, you've got to be able to analyze and underwrite deals that are maybe different than what you've done in the past. One thing you and I were
Hmm.
just talking about before this call was, what are we going to do with our property, our vacant or near vacant land that we own, and
Hmm.
how would that, what plays could we make now that are a long term vision, to take advantage of kind of softening of the market and those sorts of things, whether that's new build, sell the land now, or rent it, lease it, whatever.
Yeah, and there's different exits that you have to consider, right? So, this is something that we've been looking at heavily, especially with some of our, I don't want to say like C class properties. They're not necessarily in bad neighborhoods, but they're kind of like properties that were are projects in progress, not necessarily in terms of a renovation, but just in terms of, dealing with tenants. There's people there that we don't want to necessarily kick out. They're paying rent, whatever. But we know that there's an impending, renovation or some impending expense that we're gonna have to deal with,
Right.
right? And when we bought a lot of these places last year, it was kind of easy to have a plan of like, oh, we'll fix them up, we'll sell them, as all that sort of stuff is pretty standard. We'll keep it as a rental, whatever. But now that the market started to shift, the buyer pool is getting smaller. People's buying power is getting significantly smaller because of the rising interest rates. All of a
Mhm.
sudden, you have to start looking at other options, right? So some of the things, but so then you also have to look at what's the cause of that. So the reason the buying pool is getting smaller primarily is because people have less affordability, right? They're
Mhm.
not able to afford, the bank cost. They can't put as much down on like these larger price homes, those sort of things. But there's unique ways that you can provide that opportunity to people, such as doing seller wraps, right? Doing lease to own contracts where you're able to recover some of your money, but also cash flow, right? Different, I guess, what are some of the other stuff that we've talked about? So, like, we know people that are selling things on like a seller carry, if it's like a lower price point home, where basically you buy it cash or you bring in a private investor that isn't going to call the note, and then you can just sell it on a full on carry to somebody else instead of like in a wrap where there's an additional mortgage. So, like, for example, in Chicago, there's a very large Hispanic population, and a lot of those people, they tend to have more money but less credit, right? They don't really have credit because that's not part of their culture. So what we're doing with a lot of our deals in the Chicago area right now, we have two. We're doing this right now, where we are buying it basically as a seller finance from the previous owner, because they like, it doesn't really make sense for us to buy it as cash, or us to get a mortgage on it, just because the rates and things are so much higher, and the people don't want to give up cash flow. They don't want as much of a discount if you gain all this equity. So we're basically going to pay more for it. They're going to carry a note, and then we're going to sell it on a wrap, basically with us having a second mortgage to another party, right? We're going to recover most of our down payment, and then we're going to have a cash flow in the middle. So, if we're paying the seller $1,000 a month, we're going to charge them $1,400 a month, plus have them put a down payment. So we pull out all of our money, and we're making $400 a month as rental income,
Yep.
right? So basically, we have a little bit of spread on the front, plus we have some residual income, just like a rental property, but without having to have quite as much baggage.
Yeah.
And it's just a more creative way to do it, right? And it's the biggest challenge with these is trying to explain it to sellers, and obviously trying to explain it to even other investors. Like some of our people in our group, we go into these topics and they're just like, "What? I don't even understand what you're
Yep.
saying. But if you can start to figure out the creative financing and get into these opportunities, get into these conversations, start closing these opportunities, that's where a lot of the deals are going to come from over the next little bit, where affordability is a big issue,
Yep.
or like the one that we talked about in Spokane that we have here. It's like this janky little house that we've talked about. We had tenants in there for a while. They were paying rent. It was fine. We knew it was going to be a project. We bought like 6 months ago.
Yep.
But now like tenants are moving out. I'm looking at it and it's like, well, we have $10,000 down payment into this thing. It's not like an incredibly desirable house to list on the market, especially when the buyer pool is getting smaller. But if we
Yep.
can find someone that, doesn't mind living in a project, wants like a cheap property and can't necessarily get bank financing, sell it to them as like a lease to own sort of situation where
Right.
they are required to put money down. They can fix up the property, do whatever they want. And then we just sell it to them at kind of like a primo rent because a portion of that's going to equity on their purchase price.
Right.
And so, it doesn't make sense as a rental. We don't really want to fix it up. We don't have a good exit. So instead we find the happy medium. We basically, put someone in and they can fix it up themselves.
Yep.
And then they just get to buy it in the future. Right.
Yep.
Um,
Or we
so
tear it down and build a duplex on it.
Exactly right, and that's our other backstop on it because it is a small house. If we that was what we talked about earlier is worst case scenario, they go in and they screw up the house. Well, then we're kind of back to where we were anyway, where we have this house that's already kind of sucks. So
Yeah.
just tear it down.
Yeah. Yeah. It's a decent sized project for a small house. But we got
Yeah.
such a good deal on it. And that in itself is a seller finance deal to us. So,
Yeah.
yeah, kind of what I hear too is like what you're saying on a lot of this stuff to highlight is, what we're looking at doing and what maybe our advice to people would be is like maybe start looking at trading out of some of your crappier assets, some of your C
Mhm.
class assets that in the next couple of years are going to require major capital investment, and you may not be able to get any more rent out of it. So you're going to have to put money into it, but not actually get a better ROI for your money. So if you can trade out of those where you can take fat stacks off the table because you recently bought it, 3-4 years ago, and with where the market's been, you can still take out some of that profit really easily. Maybe retrade deals that you're in now.
Mhm.
If you're in deals where, because think about this, the bank will retrade on you too, right? They'll just come to you and say, sorry,
Mhm.
we're not going to do that deal, right? We want a 7% interest rate when you're underwriting it at 5. So you may
Yep.
have to, and we're doing that with a lot of our contracts we have now, is really that we put under contract on longer closes. We're like, hey, we can't buy your house or your building with that at that price. We need to either walk away or you need to be at this price for us because
Mhm.
interest rates have shot up, which not only affects us as a buyer, but it affects the future buyer too. Especially if it's going to be a flip property, and if we're going to wholesale it to a flipper, their end buyer is going to be paying much less because of the affordability issue. And then, yeah, lastly, talking about the affordability issue, instead of saying houses and buildings are not affordable, how can you make them be affordable so that way you can
Correct.
still do investments, you can still make money, and doing that creative financing, or whatever that creative solution you have to the affordability. Because I don't think affordability is going to change in the next 12 to 18 months per se. Maybe towards the end of next year, but interest rates can't go down quite yet. And
Mhm.
house prices, nobody wants to drop their house price right now. If they're in flight on a new build, or they're looking to sell their house this year, and they only bought it a couple years ago or whatever it is, like people just aren't ready to take a haircut on anything yet.
Mhm.
And quite honestly, they don't have to yet because there's still quite a bit of demand. And so we're in this weird spot where affordability is for the vast majority of people is going to continue to exist as an issue.
Yeah, exactly. And, ultimately what it comes down to, the people that make real money, it's in any business, real estate's no different. They're the ones who create opportunity regardless of the market conditions. The people that are basically they just ride with the market conditions and squeeze out whatever they can. Sure, you can make money, but if you want to make like big money and you want to do it consistently over the entirety of your career, you have to create those opportunities depending on what you're able to do with the current market. Whether that's, e-commerce, whether that's, a brick and mortar business, right? Whether that's real estate investing, whatever it is, learning to create those opportunities in different ways. And it is work, right? You can learn how to do one side of business, the market changes, and everything that you learned is kind of pointless now. And that's the truth, right? It's
Yeah.
just like
Yeah.
everything else. If you work for, a Boeing, right? And then all of a sudden there's a new technology that comes out that you have to learn, like the manufacturing techniques or whatever, how to build that airplane. You don't learn that, you're going to be made obsolete real quick. Exactly the same when
Right.
you're a business owner. So, okay. So in terms of creating opportunities, that's something that we're going to use for our educational topic. So for creating opportunities, the oil flood house, you guys have heard us talk about a little bit. One of the big reasons that we bought it, we overpaid for it a tiny bit if you looked at the house from face value. But one of the reasons we bought it last year now was because it had an oversized lot, and we figured out that you could basically separate out the back lot of it and sell that separately. And so we created a pretty large opportunity there, and something that several people in our group have asked us about. It's people that new investors are fascinated with in general, because it seems like you can make a lot of money in a way, like from opportunities that are, like less obvious to other people. So for our educational topic after the Instant Investor Program, Dan is going to talk about some of the things that he learned and figured out while going through that process of basically separating a lot and creating a pretty large revenue opportunity for us from that deal. So really quick, some stuff about the Instant Investor Program, and we'll be right back. The Instant Investor Program is our 12-week group coaching program, which includes a self-driven course and access to our private investor community. We will take you through the full process of how we find our leads, how we market, how we do our sales and follow-up, and how we determine the best strategy for every opportunity that comes our way. On top of that, you will also join a community of other like-minded investors nationwide that are all marching towards the same goals, and you will have direct access to Dan and myself, so you can continue learning and growing with us as we continue to adapt and grow our business. So whether you're a new investor or already established, our systems can help take you to the next level. So if you think you might be a good fit, go to theinstantinvestorprogram.com and schedule a call, and we can have you talking to motivated leads in as little as 2 weeks. All right, welcome back, everybody. A lot separations. I'm not sure I'll title this creating opportunity by splitting a lot, or by these different land plays. It's something it's kind of sexy on Instagram. You see people talk about this stuff all the time, how they bought an acre and turned it into these lots and sold to a developer or whatever. But this one was kind of unique because it was a house with an extended lot. We basically created an infill lot, which I would argue is almost better because that individual lot is freaking valuable. If you look at the location.
Well, so we have a couple different scenarios, or I guess things we can talk about as far as lots we've got going on.
Well, I guess let's talk about the how of doing the one with the oil house. How exactly?
Let's get in that. But I want to preface it by saying look at what's going on around you before you do stuff like that. Because it might not make sense for you in your market. If you guys have land, right now is not the best time to be picking up big chunks of land to subdivide for a developer, because developers are pulling back right now. It's probably not the best time. Nobody wants to hold on to land right now. But if you already have it, or you're negotiating with somebody that has land, that has some something unique about it. In the case of this place, it really wasn't quite apparent, other than the fact that when you walked around it, the back lot, first of all, it's a corner lot. Okay. So that's interesting. So there's two different approaches via two different roads. The location is great. So we knew the house itself would hold value regardless of what happened. So the risk there, we're you don't really get, you can get better location, but this is pretty dang good location. But one of the houses adjacent to the backyard was built on a lot that looked like the same size of this backyard. Right?
Exactly.
There's not many other houses with that sort of lot size, but we saw that one. It's okay, pretty sure we can do something with this. So then the first step you always want to do is just call whoever, the city, the county, whoever's in charge of the land development, the zoning and all that sort of stuff, and ask them, hey, and at least in our market, they're pretty easy to work with. You call them and just ask them some questions, and talk to them about, hey, I've got this property I'm buying or that I've purchased. I'd like to see if I can subplat this into two lots. Can you take a look at it? And then they'll tell you what your options are. And then also looking at zoning, talking to your zoning department, if you need to re-entitle a property, which basically change the entitlements of what you can do to that property, whether that's take it from a single family to being able to build a duplex or a multiplex or whatever, just looking at that zoning. So initially that's an important task too, to know, because whatever something is doesn't mean it has to stay that way. And that's where you can create value. And that's why you have to recognize the opportunity ahead of time and then work with your local government, zoning departments and development departments to see what you can and can't do with that lot, because that can change and swing the value a ton. The second thing that you want to look at initially as you're looking at these opportunities is where are the utility hookups, because that can be a major cost. Again, on this one, we were lucky because this was on a corner lot and there were utilities, water and sewer mainly, in the road in front of the existing house, as well as down the adjacent road perpendicular to it. So we had two options. One, we could just go through our existing property with an easement to grab off of a side street water and sewer, or we could go off more of the main busier road and grab water sewer there at a shorter distance. So I knew that would be easy to do. But then you can also call those departments within your city or your county and say, hey, what would it cost to get a tap from this lot to that, from this line to this? And then I would say you do the exact same thing for your electric and natural gas if that's an available utility. Call your utility company that's a provider and say, hey, what's going to cost for me to bring in gas and electric from this location to this location? And they'll tell you. And now you have your cost for water, sewer, electric, and gas straight from the people that are going to do it for you.
Yeah. So I think one of the key points you're making across the initial conversation of what you're allowed to do and then the utilities is don't be afraid to just ask people. I think one of the biggest things that a lot of people worry about when they sort of sense there's an opportunity like this is they go, well, I don't know how to do that. Well, neither did we.
Or it's perceived to be harder than it really is.
It's perceived to be harder, right? Yeah. I mean, and it does take a while, but remember when we were first underwriting this deal, we locked it up at a price that was too high for the house, and we knew that, right? And basically our plan was to just do underwriting on it and figure out what we could do with that back lot before we actually closed. So, we signed the contract, we had a 30-day close, then we got to work, and we were calling the city, we were calling all the utilities like that. And I remember because I actually called the city initially to sort of see if we could, what it looked like to separate that lot off and like if we could even do that. And I called up and I was like trying to explain to the lady what we wanted to do. And she was like, have you ever done this before? And I said, no. And she was like, okay, that's fine. And then she just gave me like the elementary school version of what we needed to do. Right. Like it's not like they're expecting you to be an expert. Like they're willing to work with you in most places. I mean, I'm assuming most places are like that. There might be, depending on your town or county or whatever, they're like, well,
maybe not all, but most,
But most of them are going to be pretty good. And then same with the utility folks, right? They're going to tell you what has to be done because they're like legally required to. They're not going to like let you do something illegal or like sort of hang out to dry by telling you something's easier than it is. I'll say if anything, most of the time they're more conservative and they're going to tell you that it's more difficult or that it's more expensive than it probably could be if it was done, one way or another. So
so I would say within a couple week period of time, if you're talking about a simple what we call in our market like a short plat, subplat, where you're basically going to take one lot, turn into two lots. Within a week or two, you can have called all of these people and figured out if it's possible and roughly what cost. So you would call your city or county and or both, figure all that out, what you can and can't do with it, what their fees are. In our market, it was like $5,000, which is crazy, but we had to pay that much. And we found the whole process out, and then we had to pay for a surveyor. So you can call a surveyor. We had to pay like $5,500 for him to do all that. Mm-hmm. Then you can call your utility companies, see what it's going to cost to get utilities to that property. Then you can call some builders and say, hey, what do you charge per square foot to build something at like a rental grade? Or maybe you're trying to build a mid-level home for somebody. They're going to tell you, anywhere, depending on your market, maybe it's $150 up to $300 a square foot. So you can say, well, if I build an average size house, which is in this neighborhood, maybe it's 1,800 square feet, and the builder said it's going to be 200 square feet. Plus then you have all these utility costs, any entitlement costs, any survey subplat cost. Now you can add all that together and say, well, it's going to cost me $300,000 to build this home and have it all ready to go and turnkey. But places are comping for 500 in that same area. And now you're like, okay, I got a $200,000 spread here.
Yeah.
That's really all we did. We didn't even look at building because we just knew the location was great, that we knew there would be a good spread on the land itself to sell to a builder. Because not that we don't want to do this, but we just aren't haven't ever done a new build. Maybe we will. Maybe
Exactly.
this will be the
Yeah.
first time we do it. Who knows?
Yeah, and we flipped infill lots. This is like, a class neighborhood in
Mhm.
Spokane, super desirable, and I mean we've seen lots on like the hot streets in the area selling for like up to $300,000. This
Right.
isn't quite that level, but I mean 200 to 250 is definitely a possibility.
Well,
Um,
and the thing I posted on my Instagram recently, if you don't follow me, it's at Investor Man Dan Instagram.
there you go. There
Um,
you go.
that literally the day we went out to public comment for the final, it's like a 2-week public comment you have to do whenever you make changes to your property. Um, eh, the city announced that they voted in a change
Mhm.
for affordable housing issues, meaning that you can put ADUs or DADUs, DADUs, and stuff like that. They've changed the laws to those,
Yeah,
but
well,
more
they
importantly,
basically changed the rules for the zoning. So we've always had
right,
really strict single family zoning in
yes,
Spokane, but they basically made
it's
it so that
created urban sprawl.
yeah, exactly. They made it now so everything that's single family now you can build like 2 units if it's
Yeah,
a certain size of
you can
lot, which
build a
is smaller.
duplex on any lot,
Yep.
and you can before you could have an ADU, but it had to be a family member that rented it from you. Now you can have that
Mhm.
second ADU, and they changed the square footage of that ADU. Before it was like 600, now it's like 800. They have some different rules, and this is within our city limits. Um, and so it's just perfect timing for
Yeah.
us, anyways, on that.
Yeah.
And so that changes the value, in my opinion,
Mhm.
probably to higher value because now there's more uses
Yep.
for it.
Exactly. Yeah, we finally, after 2.5 years of business, we finally had a change that was luck in our favor,
Yeah.
not
Well, and if
against
you
us.
think about it, and let's just do back of napkin math for those listening and following along. So say, we'll just run the numbers, right? So we paid 300,000 for this house, right?
289,000.
289. We did about a $90,000 renovation, which included furnishing it.
Yep.
And then we just paid 10,000 for a furnace. So,
Yeah.
whatever, say we're at 400 all in on this thing.
Mhm.
Um, and we'd done a cash out refinance, all that sort of stuff.
It appraised for
We
450,
praised for 450. So as a flip, we would have made money.
barely.
Um,
Yeah.
Barely. We would have made we wouldn't have lost money.
Mhm.
So say we're at 400,000 all in, and now we're another say 12,000 into this subdivision of this lot. Now we have a lot there. What if we can build a duplex, which in that neighborhood could easily rent for $2,000 a unit per unit
Mhm.
for a 2-1 or maybe even a 3-2 if you could squeeze it in their unit. So that's $4,000. So could we build something for $400,000 in our market that which would make it a 1% rule? Absolutely. So we
Yeah.
could easily build a 1% rule duplex and then have a cash flowing asset that we're pretty much a bird out of already next door to it too.
Correct.
That
Yeah.
makes pretty good sense, right? From
Yeah,
my back of the napkin math.
if we were going to build, or even if we were going to sell it, it goes from being a flip where we're into it 400 and we're trying to sell for 450, and if everything goes well, that would make like $5,000,
Right.
right? But there's holding costs, right? So really, it would be less than that potentially. Or we go into this flip, we're into 400, we're into we sell it for 450, but now we've created this lot that's worth $200,000. All of a
Right.
sudden, the house that we ever paid for is a $200,000 profit.
Absolutely. A huge flip, right?
Huge flip.
Yeah, exactly.
Yeah, yeah. I
Uh,
mean, when was the last time someone did a $200,000 spread on a $400,000 property? Not
right.
very often.
No,
Very rare.
it's a good deal. So more to come. Mike and I kind of like to build. I want to build stuff. Mike wants to sell stuff. So we'll let you know what we end up doing on that one and share the
Yeah,
numbers. We can do a
yeah,
case study on it.
yeah. It'll be interesting endeavor because especially going into new builds and things like that right now. I think like developments are becoming less desirable, but at the same time, this is also in a neighborhood that, like I said, is super hot, and generally it's hard to find like nicer houses in. Just because
Hmm.
like they're old classic houses, something that's fresh and clean in this A class
Yeah.
neighborhood, I think will continue to be desirable no matter what
Yeah.
happens in the market conditions.
Absolutely. Yeah.
So cool. So you have anything else on that topic that you want to share? Any other good learning points? Like, I guess all in. So one thing we didn't cover the total cost through that lot separation. I know it'll be different from place to place, but like, what's a reasonable expectation for someone?
Yeah, I would say per lot in like a market like ours, which is I would say mid-range expensive, not the most expensive, but we're in the middle. We're a decently expensive secondary market, right?
Hmm.
Ours and actually that doesn't even matter because everywhere's going to be different on depending on your taxes and what your county and city require as well as state. But we were 10 to 12,000. So if you're going to do a few different lots, you're going to you could probably estimate that much. It will definitely be a per lot thing, but as you gain scale, it won't be 10,000 per lot. But half of that cost was just to pay the surveyor, right? And so you might pay a surveyor. You might be doing a quadplex or a 4-unit lot separation. Maybe you pay, instead of $5,000, you pay $10,000. You're not paying him, $20,000 to do the survey, but you're going to pay him a little bit more. And then the city will always have like a tax per certain thing that you're doing, whatever those are. So that will always add up. But again, with scale, the price is reduced per lot.
Correct. Yeah. Okay.
It's not cheap. I would say this is not cheap.
Yeah, it's not cheap. I mean, 10 to 12,000 for something that's worth 200. That's pretty good.
Right. But if a typical infill lot in your market is selling with utilities at 70, and you're going to put $15,000 plus 6 months of carry into it on taxes and stuff like that, you're going to be like, it's not like a super screaming deal where you're making a ton of money, but it's still worth doing.
Yeah, absolutely. And so the biggest thing is going, and even just go on Zillow and see if there's like pending. You can filter by lands and lots and just see if there's stuff that's either pending or has sold in the immediate area and what those sold for. Because you're right, the complete contrary, if we look at, stuff we do in Dayton, Ohio, they're like giving lots away over there. They're like, please take this thing.
Well, and their property taxes are so high. They're like, I'll sell you my house, but you have to buy the lot next door. It's like, no, that's all my cash flow. They got a $500 a month tax payment on a piece of land that nobody wants.
I know. Like, we literally had that conversation with somebody where they said they would love this on my property, but I will throw in this lot for free, but you have to take it. So that way I'm not stuck paying taxes on it.
Yeah. Which it sounds like a good idea, right? But no, it's a terrible idea. Don't ever take the free lot.
Yeah. So always do your own due diligence there. All right, guys. Well, that's our show for this week. Thanks for listening. If you could please go like, subscribe, download, and share this podcast with anyone who you think might find it interesting. That really helps us out a lot. Go ahead and follow us on Instagram. I'm at Mike_invest. Dan is at InvestorManDan. And if you want to learn from us and, sort of see how we grew our business, how we're teaching other people in our mastermind group to grow their business, go to instantinvestorprogram.com. And there's a calendar link there. You can book a call with one of us. So go check that out. And we would love to see if you'd be a good fit. And aside from that, anything else?
No. If you want to learn more about lot stuff, I'm by no means an expert, but I do know some experts. So feel free to reach out, walk you through it. Other than that,
cool.
See y'all next week.
Right on. Thanks, guys. See you guys next week.
Thanks for listening. Please leave us a review on iTunes or wherever you get your podcasts. And check us out at collectingkeyspodcast.com for tips and guides on starting your own real estate investment and wholesaling business.